Hi there, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of December 31st, 2025. Thanks for tuning in. Before getting into the charts, let's take a moment to look at the broader backdrop. Early January brought attention to Venezuela, and while the direct economic impact is limited, situations like this tend to matter for markets because they add uncertainty. Energy markets, trade relationships, and policy expectations all become a little harder to handicap when geopolitical risk picks up. Even when prices don't move dramatically, volatility and investor psychology often do. One useful way to think about events like this is that they don't replace the current economic story, they layer on top of it. Growth, inflation, interest rates, earnings, currencies, and geopolitics are all interacting at the same time. When something unexpected happens, it doesn't suddenly change the fundamentals, but it can influence sentiment, risk taking, and how markets react to new information. That's often when discipline and diversification become especially important. Against that backdrop, this quarter's review focuses on a few key themes shaping the outlook for 2026. Economic growth is expected to continue, but not in a straight line, with strength early in the year and some slowing later on. Inflation may move a bit higher before easing again, and the Federal Reserve appears increasingly positioned to continue cutting interest rates as growth and price pressures cool. The discussion also looks at corporate earnings, currency movements, and why balance across asset classes and regions matters at a time when market leadership has become more concentrated. As always, I use JP Morgan's Guide to the Markets to help connect the dots and put these trends into perspective. Feel free to pause anytime if you'd like a closer look. All right, let's get started. The economy is expected to accelerate early in 2026 and then gradually slow as the year progresses, averaging about 2% growth overall. That suggests steady expansion rather than a boom or a recession. Growth weakened late in 2025 as several pressures hit at once. Tariffs raised costs, a federal government shutdown disrupted activity, and slower immigration limited labor force growth. Together, those factors reduced economic momentum toward the end of the year. Despite those headwinds, demand held up. Businesses continued investing heavily in artificial intelligence infrastructure, and higher income households maintained solid spending, supported by strong stock market gains for a third consecutive year. These forces helped stabilize growth heading into 2026. While late 2025 growth appears to have been soft, a rebound is expected in the first half of 2026, with growth closer to a 3% annual pace. Higher income tax refunds should support consumer spending early in the year. As that temporary boost fades and without additional fiscal stimulus, growth is likely to slow later in the year. Overall, the economy is expected to grow at roughly a 2% pace in 2026, modestly stronger than in 2025, with faster growth early in the year and more moderate growth as the year continues. Job growth slowed sharply in 2025 as weaker economic growth, a smaller labor supply, and federal government job cuts all weighed on hiring. Between May and November, average monthly payroll gains dropped to just 17,000. In early 2026, job growth is expected to rebound briefly, rising to roughly 50,000 to 100,000 jobs per month as consumer spending improves. As the economy slows later in the year, hiring is likely to cool again, falling below 50,000 jobs per month. Even with modest job creation, the unemployment rate is not expected to rise significantly because immigration has slowed. Illegal immigration has fallen sharply, deportations have increased, and fewer new immigrant visas are being issued based on available data. Net immigration now appears to be running below 250,000 people per year, compared with more than 1 million per year on average before the pandemic.
With little growth in the working age population, the unemployment rate is likely to hold near 4.5% in early 2026 and drift closer to 4% later in the year. Wage growth has cooled but should stabilize as ongoing shortages of qualified workers help offset concerns about a slowing economy. Inflation is expected to rise early in 2026 and then ease as the year goes on, moving back toward 2% by year-end. The early increase is largely tied to strong income tax refunds and the delayed pass-through of tariffs into consumer prices. Recent inflation data have been difficult to interpret because the federal government shutdown disrupted data collection. The October CPI survey was canceled, and November data were collected late. Even so, inflation appears to have risen to about 3% year over year in December, up from roughly 2.7% in November. Inflation could move higher in early 2026 as tax refunds boost consumer spending, giving retailers more room to pass along higher costs from tariffs. However, several factors should limit how far inflation rises. Wage growth has slowed, gasoline prices remain low, and housing demand has weakened, all of which reduce broader price pressure. As a result, inflation is expected to peak near 3.5% by mid-year before falling back toward 2% by the end of 2026. Taken together, the overall outlook for 2026 remains balanced, roughly 2% economic growth, no recession, inflation returning to 2%, and unemployment easing toward 4%. The Federal Reserve could cut interest rates twice in 2026, with the possibility of a third cut if both economic growth and inflation continue to fade. The Fed lowered the federal funds rate by a total of 0.75 percentage points in late 2025, following a full percentage point of cuts in late 2024. Those moves brought the policy rate down to a range of 3.5% to 3.75%. Financial markets are currently pricing in better than a 50% chance of another cut in the first quarter of 2026 and a near certainty of at least one cut in the first half of the year. Assuming there is no additional burst of fiscal stimulus, another rate cut by September appears plausible, which would bring the funds rate down to roughly 3.0% to 3.25%. That level is close to the Fed's own estimate of a neutral rate, meaning a rate that neither stimulates nor restrains economic activity. If the economy weakens again later in 2026, especially if political conditions reduce the likelihood of further fiscal support, the Fed could shift toward a more accommodative stance. In that scenario, rate cuts would not necessarily stimulate growth, but they could push policy gradually closer to very low interest rate territory, once again heading into 2027. The U.S. dollar could weaken further in 2026, reflecting slower U.S. economic growth and continued interest rate cuts by the Federal Reserve. The dollar declined sharply in 2025. Part of that move likely reflects how expensive the dollar had become going into the year, along with the United States' ongoing trade deficits. However, the decline may also reflect growing questions among both domestic and international investors about heavy concentration in U.S. assets and uncertainty around U.S. policy direction. Over the longer term, one of the most important drivers of the dollar has been higher interest rates in the United States compared with other developed economies. That rate advantage has supported demand for U.S. assets and, in turn, the dollar. As the Federal Reserve cuts interest rates more aggressively than other central banks in 2026, that advantage is likely to narrow. Combined with a still large trade deficit, those forces point toward continued downward pressure on the dollar over the course of the year. Earnings expectations remain elevated. Analysts are currently forecasting roughly 15% earnings growth this year and next, which appears optimistic. A more realistic outcome points toward upper single-digit earnings growth, assuming the economy continues to expand without slipping into recession. A major support for profits continues to come from technology investment, particularly in artificial intelligence. Companies are spending heavily on data centers, advanced chips, and related infrastructure. That capital spending doesn't just stay on balance sheets, it flows through to revenues and ultimately corporate profits. At the same time, companies have been disciplined on costs. Many businesses are operating more efficiently than in prior cycles, helped by technology adoption and improved processes. These productivity gains allow companies to grow output without a proportional increase in labor or operating expenses. Looking ahead, productivity is expected to remain a meaningful support for profits. Even if top-line growth moderates, efficiency gains and controlled costs should help sustain earnings growth at a healthy, though more moderate pace. Consumer sentiment remains very weak. In December, sentiment measured around 52.9, and even after adjusting historical data for changes in survey methods, confidence levels are still lower than they have been roughly 94% of the time over the past several decades. What makes that especially striking is that by traditional economic measures, conditions are not nearly that bad. If unemployment and inflation are combined, a common way to gauge everyday economic pressure, that total is lower than it has been about 3/4 of the time over the last 50 years. By those metrics, the economy looks better than average, yet people feel worse than they have roughly 95% of the time. That disconnect raises an important question. Why does public confidence look so depressed when the underlying data do not fully support it? Several factors appear to be contributing. Social media has had a meaningful negative effect on how economic news is experienced and shared, amplifying fear and frustration. Political polarization also weighs heavily on sentiment. In addition, rising inequality has left many households feeling that economic gains are uneven, even during periods of overall growth. One chart in the guide looks at growth in household net worth by income group, and it helps explain the disconnect between weak consumer sentiment and continued economic momentum. Since 2019, the stock market has delivered strong gains despite a setback in 2022. Of those gains, roughly $41 trillion has gone to the top 20% of households, compared with about $16 trillion for everyone else. That imbalance matters because higher income households play an outsized role in the economy. The top 20% account for about 38% of total consumer spending, while receiving roughly 51% of pre-tax income. In other words, the households with the strongest balance sheets also have the greatest influence on overall spending. Consumer sentiment, however, does not work that way. Every household gets an equal voice in sentiment surveys, regardless of income or wealth. The economy itself is far less egalitarian. Income growth, spending power, and economic momentum are driven disproportionately by higher income households. This helps explain why consumer confidence can remain depressed even while spending holds up. Stronger incomes and rising wealth at the upper end of the income distribution can continue to support consumer spending into 2026, even if broader sentiment remains cautious. Bond yields now appear close to fair value, which argues for a neutral bond allocation rather than a strong directional bet. Long-term interest rates have drifted lower in recent months as the Federal Reserve resumed easing and signs of a softer labor market emerge, even while inflation has edged higher. From here, long-term rates are likely to remain range-bound. The effects of easier monetary policy are expected to be offset by increased Treasury issuance, a temporary pickup in economic growth, and delayed inflation related to tariffs. In this environment, there is not a compelling case for making a strong bet on either interest rate duration or credit risk within bonds. Even if economic growth slows further, any rally in bonds is likely to be limited by rising federal borrowing needs and inflation that remains slow to fully retreat. At the same time, a recession is not expected in the near term, which helps explain why credit spreads remain relatively tight. Taken together, these conditions support maintaining roughly normal bond allocations rather than leaning aggressively in either direction. Historically, when broad bond yields have been near current levels around the low 4% range, subsequent 5-year returns have tended to be similar. If inflation continues to fade later in 2026, today's yields and expected returns appear reasonable for long-term investors. Mega cap U.S. stocks continue to look expensive relative to the rest of the market. In recent years, the largest companies in the S&P 500 have significantly outperformed both in earnings growth and stock price gains. That strength largely reflects the dominant market position of U.S. technology firms and a surge in interest and investment tied to artificial intelligence. However, stock price gains for these companies have generally outpaced their underlying earnings growth, pushing valuations well above those of the broader market. As a result, the gap between mega-cap stocks and the rest of the market remains unusually wide. That imbalance is still evident today, with the top 10 companies in the S&P 500 accounting for roughly 40% of the index's total market value. This level of concentration is historically high and increases the market's sensitivity to setbacks in just a handful of companies. For long-term investors, this concentration argues for broader diversification. Shifting some exposure toward other areas of the market can help reduce risk if economic, geopolitical, or company-specific developments cause the current mega-cap boom to reverse. International stocks continue to look inexpensive relative to U.S. equities. In 2025, international markets sharply outperformed U.S. stocks as gains in local markets were boosted by a weaker U.S. dollar. After a year like that, it's natural to wonder whether the opportunity has already passed. Even after that rally, international stocks still trade at meaningfully lower valuations than their U.S. counterparts. The valuation gap remains wide by historical standards, suggesting that relative value is still on the side of non-U.S. markets. Currency dynamics also matter. The U.S. dollar remains elevated relative to long-term trade fundamentals, and further dollar weakness over time would provide an additional tailwind for international investors. Finally, after a decade of U.S. market dominance, many U.S.-based investors remain underallocated to international stocks relative to a balanced long-term portfolio. That positioning creates room for increased international exposure without relying on aggressive assumptions. This slide shows how different asset classes performed over the course of 2025 and why diversification continues to matter. By year-end, most major markets delivered strong results with gains spread across stocks, bonds, and regions. U.S. equities finished the year up solidly, but international markets performed even better. Emerging markets international stocks posted gains around 34%, while emerging markets were up around 31%, marking one of the strongest periods of international outperformance relative to the U.S. in many years. Bonds also contributed with both core fixed income and high yield generating positive returns. What stands out in 2025 is how broad-based the gains were. Unlike recent years, when performance was driven by a narrow group of large technology companies, returns this year were more evenly distributed across asset classes, regions, and styles. A diversified portfolio, represented by the gray box on the slide, benefited from that balance. The key takeaway is that diversification continues to work. Staying invested across different parts of the market helps capture opportunities as leadership changes and reduces reliance on any single theme. There you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's video. As always, please feel free to reach out to me to review this and more.